Imagine this. You wake up one morning, check your bank account, and realize the American dream, owning your home, is slipping out of reach for millions of people. Foreclosures are up 20% and climbing. Homeowners are stressed, the economy is shaky, and yet, home prices keep rising. Confused? You should be. Today, we're breaking down exactly what's happening in the housing market, what it means for you, and whether a crash is really coming. Yes, your eyes aren't deceiving you. Home prices are going up while people are losing their homes. It's like buying a Tesla while your gas tank is on fire. Weird, right? Stay with me, because by the end of this video, you'll understand the numbers, the risks, and the smart moves to protect your wealth before it's too late. Across the United States, whispers of a housing crisis are growing louder. Headlines scream foreclosures surge and housing market on the brink. But what's really happening behind the numbers? Today, we're diving into the truth, the real story behind rising foreclosures, regional risks, and what it all means for you as a homeowner or future buyer. Buckle up, the picture is more nuanced than it seems. Let's start with the hard numbers. Foreclosures are up 20% year over year, marking the 8th consecutive month of increases. That sounds alarming, right? But context is everything. The actual percentage of mortgages in foreclosure is still only about 0.5%, well below the historical average of 1.5%, and nowhere near the 4% we saw during the 2008 housing crash. So while the headlines scream crisis, the reality is far less dramatic. So, does a 20% jump mean we're in free fall? Not quite. Think of it like this. It's as if your favorite pizza just went up 20 cents, and suddenly you assume you need to sell your house. A jump in percentage can look scary, but in real numbers, it's manageable. Foreclosure activity isn't happening evenly across the country. Some states are definitely feeling the heat more than others. Florida is leading the pack, followed by South Carolina, Illinois, and a handful of other southern and Midwestern states. Meanwhile, large portions of the Midwest and Northeast remain relatively stable. Your personal risk depends heavily on where you live, not just what the national headlines say. So, location matters more than ever in this landscape. Now, here's where it gets interesting. Despite rising foreclosures, median U.S. home prices are still up 1.4% year over year, currently sitting at $440,387. Unlike the mid-2000s, foreclosures aren't happening at a scale large enough to flood the market and push prices down. It's a bit like noticing cracks in your coffee cup, but the coffee hasn't spilled yet. Everything is relatively calm, but it's wise to keep an eye on the cup. In other words, don't panic, but don't ignore it either. So why aren't we seeing a massive foreclosure spike just yet? For one, most homeowners are still managing their mortgages. About 72% of mortgage holders are locked in at 5% interest or lower. That kind of low-rate cushion makes a big difference when budgets get tight. Secondly, rising home prices have created equity cushions. Homeowners can tap into that equity through refinancing, home equity lines of credit, or selling if needed, instead of losing their homes outright. This combination of low rates and rising values is holding the foreclosure tide back, for now. But here's the question that keeps economists up at night. What happens if interest rates rise further, or the economy slows down more than expected? Could this calm before the storm be just that, a brief pause? Stick around, because we're diving into that next. And trust me, the answer may surprise you. To understand the risks today, we need to look back. Between 2008 and 2012, the housing market hit a crisis unlike anything most of us had seen. Foreclosures skyrocketed to 4% of all mortgages, flooding neighborhoods with distressed homes. Prices plummeted, in some areas, by more than 30% nationwide. Now, compare that to today. Current foreclosure levels sit around 0.5%. That's a fraction of what it was during the Great Recession. In other words, while the news may feel dramatic, the market hasn't reached that tipping point yet. The difference between fear and reality is striking. 0.5% versus 4%, perspective matters. Here's the tricky part. real estate is local, not national. Florida, for example, is seeing high foreclosure activity in certain cities. Some neighborhoods there are starting to experience modest price declines. Meanwhile, in the Midwest and Northeast, markets are stable, with modest price gains continuing. This is why national statistics can be misleading. Your strategy, whether you're buying, selling, or holding, needs to be local, not based on a nationwide headline. The health of your local market will largely determine your risk, not the national average. Even with a surge in construction since the pandemic, the U.S. still faces a housing shortage of 3 to 4 million homes. That's right, a decade of underbuilding has left demand far outpacing supply. This shortage prevents a nationwide crash, because you can't crash a market if there simply aren't enough homes to sell. Think about it, can you really crash a market if there aren't enough homes to sell? That's like expecting the line at Starbucks to vanish just because they opened one tiny kiosk down the street. Not enough to matter. Now let's talk about one of the biggest wildcards, the Federal Reserve. Monetary policy can move markets. When the Fed injects trillions into the economy, it can keep asset prices, including homes, elevated. This is a double-edged sword. On one hand, it prevents a sudden crash in the short term. On the other, it creates uncertainty for long-term affordability, making it harder for first-time buyers to step in and for middle-class families to stay ahead. So if a crash isn't imminent today, when could it happen, if at all? And what does it mean for your wallet, your investments, and your financial future? Stick around, because the projections coming next may change how you view the housing market forever. Even if a full-blown crash isn't coming soon, market corrections are inevitable. The smart move is to understand your exposure. If you own a home, ensure your mortgage is manageable and consider building cash reserves. If you're a buyer, focus on affordability and location, not headlines. Corrections create opportunities. Distressed properties, especially in high foreclosure areas like Florida, may offer bargains for cash buyers or investors. But timing is everything, patience is key. Your financial future isn't determined by headlines. Diversify your assets, maintain liquidity, and avoid speculative overreach in housing. Remember, wealth is built over decades, not months. 1. Foreclosures are up, but still historically low. 2. Prices remain elevated, local trends matter. 3. Equity and low rates cushion homeowners. 4. Shortage of homes supports prices. 5. A crash isn't imminent, but corrections are inevitable. Watch for signs like rising rates, economic slowdown, or massive foreclosure spikes. Those will tell you when the real danger is approaching. Think of it like a roller coaster. You're strapped in, heart racing, but if you keep your hands on the bar and eyes open, you can enjoy the ride, and maybe scream a little too. So, here's the reality. The headlines are scary, but the numbers tell a more nuanced story. Foreclosures are rising, but not enough to crash the market today. Home prices are holding, equity is strong, and opportunities exist for those who prepare wisely. If you found this breakdown helpful and want to stay ahead of the housing market trends, click subscribe and hit the notification bell. I'll keep you updated with the latest insights so you can make informed decisions and grow your wealth, even in uncertain times.